and there are other ways to do it, and that's what I want to talk about. Had the crash of '29. Remember, now we had the Federal Reserve. We got the crash of '29, and FDR is elected, and he's a reformer, and he goes, you know, we just came through this other crash. We've got the Fed. The Fed was created to make sure we don't do that again. And what do we got? The Chicago Plan for Monetary Reform was developed by a national group of economists, mostly the core, I should say, the core of which were at the University of Chicago, mostly with Henry Simons and others, and also from Princeton, Columbia, and all the various universities. So we're talking about economists. This is probably the best thing I'm going to say about economists all night, to be honest with you. But we're talking about the economists. They sat down and they said, here's a plan. Here's a plan. We've come up with a plan that will solve this problem. Because what FDR wanted was economic stability. We want to do away with these crashes. We want to do away with people losing their wealth in incredible scale and quantity during these crashes, and that's what happened. It was developed, presented to FDR, presented to his cabinet. We know that he saw it. It had widespread support in government. Who do I mean by that? I mean the people that were in the administration who knew that FDR had a grand ideal, a grand ego, and a grand plan for meeting, the needs of the people, and he was going to do it. And they, a lot of people within the administration were, this is the way to go. But it was introduced in both the House and Senate. That is to say, it didn't just go there and die. They were progressive, very progressive, and very conservative. Both Congress people, both parties got introduced, but got wiped out. They never actually made it out of committee in either house. And we can talk about why, and books have been written about why, but it's a fact. So it never made it. So it never made it out. The Chicago Plan. I want to go back to the Chicago Plan, and it should be obvious why. The stated objective. Now, if there's anybody out there who thinks that this would not be a good objective, for Mr. Obama to give to Mr. Geithner right now and say, Mr. Geithner, the plan that I want you to come up with is not the one that puts trillions of dollars of taxpayer money at risk to bail out the banks that caused this problem, but instead, how about if we provide an adequate, stable monetary system that prevents bank failures? Prevention. To prevent uncontrolled inflation, to prevent depressions. Provide a system to control prices of commodities and stabilize the purchasing power of money. To restore normal prosperity. Whoa, normal prosperity. It's gone. And to assure its continuance. There's a monetary policy I can believe in. What is it? How is it going to work? This is kind of those were the goals and the purpose and the intention, and that's what we want to do, and this is how we're going to do it. We're going to segregate demand from saving deposits, and there's a real important reason having to do with relative to money creation why you're going to separate demand deposits, which is your checking account, from the money that you have that you want to take and invest and actually make some other money with. Okay, the question is, one of those should have risk attached to it, and one of them shouldn't. And you should be free to make sure that you make the decision about whether it has risk or not. And the way you do that is you segregate your demand from your savings deposits. Require banks to keep 100% reserves against demand deposits. That's a little too complicated for me to explain to you. But what I would tell you is this. That's how you take risk out of the system. That is how you take risk out of the system. Instead of banks creating debt to create money, banks lend real money. And they maintain 100% reserves. We do away with fractional reserve lending. 5% reserves required against the saving deposits. Again, that's a different category. Everybody doesn't want to be risking all of their money. Establish a federal monetary authority with full control over the supply of currency, and that means money, the buying and selling of government securities, and the value of the dollar, which at that time was still tied to gold. But that was part of, you know, part of that they were going to undo. Have the Federal Monetary Authority hold bank bonds to provide the 100% reserves. And that's, again, it's a technical thing, but here, this is something that you and I wouldn't really have any relation to. Have the FMA establish a 1926 price level and maintain that price level. Why? Why? Because since 1926, we had deflation up until 1934, okay? We had deflation. We had wages going down. We had nobody working. We had prices going down. Nobody knew what was going to be happening next. And they said the way to restore confidence in the economy is to build the price level back up to 1926 level when this thing started crashing. The Chicago Plan legislative proposal, which, remember, it was in the committees, died with the passage of the 1935 New Deal era banking reform legislation that regulated the activities of the private banking system. Some of us and some people in this room are familiar with Glass-Steagall, you know, the banking reform legislations of 33 and 35 both, that gave us the federal deposit insurance. Federal deposit insurance. Isn't it great? Isn't it great that we can actually insure our deposits? But with 100% reserves, there's no need. There's no need for federal deposit insurance. And there's no need for a lot of other stuff, quite frankly. There's no need for the Federal Open Market Committee and its setting of interest rates to try to maintain the right amount of money in the economy. No, all that stuff would go by the wayside with this plan. So that's how I see it. Wholesale deprivatization of the money creation powers of the Federal Reserve banks. Establish a government issue of currency. A government issue of currency. Debt-free money. Yeah, that's what they were calling for. And all money is needed to provide exchange media. And right there you go back to the essential function of money. The essential truth about what money should be, which is the means of exchange. To provide a means of exchange between that which is produced and that which is consumed. There's the economy, folks. Produced and consumed. You hear about supply and demand. Money's the thing that makes it all happen. But when money becomes a commodity, when money becomes something that is going to be taken out, and it's going to be, other things are going to be done with it, like, how about a derivative? How would you like to have a derivative? Would you like to invest your money in that? When the money becomes things other than what it really should be, we get to the problems. Exchange media, a de facto debt-free government issue. Now, these were the other things that were in there. Removal of gold in setting currency valuations, okay, because that was a problem. At that time, believe it or not, we were dealing with large volumes of gold going here and there, volumes of gold going across the ocean and back over the ocean. Oh, you know, it was kind of crazy. All demand deposits on a full reserve, 100% reserve, and there's a good reason for that. Interim government guarantee of all deposits. So we said we're going to go until the 100% reserve plan. So my point is, the Glass-Steagall, the FDIC, those were interim measures. Those were interim measures, so that we could go back and review what needed to be done. But we never got back to reviewing what needed to be done. And this is why I'm saying this was why, because it was greenbacks. They were talking about going back to greenbacks. Greenbacks. That's where we need to go. The way forward is with greenbacks.